Hi, Mark Anderson here, mortgage banker with Paramount Bank. I am licensed to lend in all 50 states, and I would love the opportunity to earn your business. For today's mortgage rate update, as much as it pains me to say this, I was right when I recommended to lock in on Thursday. My read of the market at the time was informed by the simple fact that the largest variable determining what's going on in the mortgage bond market, and therefore the largest variable that is going to impact day-to-day mortgage rate changes, is this artificial stimulus program brought to us by the Federal Reserve. Essentially what the Federal Reserve is doing is they are buying a lot of mortgage bonds. They are the single biggest buyer of mortgage bonds on a day-to-day basis. And when their taps are open, the mortgage bond prices go up, which should cause mortgage rates to go down. Conversely, when they turn off that tap, the mortgage bond prices go down, and there is a tendency, therefore, for mortgage interest rates to go up. What we saw last week is a phenomenon that I've talked about before. The big institutional lenders seem to be very reluctant to sweeten their pricing when the mortgage bonds are high. It actually took a couple days of sustained bond price levels above this 104 threshold for the rates to actually get any better at all. As a reminder, to give you a picture over the last, let's actually just look at the last, 3 months here. This is the period of time in early March when we saw the best mortgage rates, really the best mortgage rates throughout history. And you see a bond price level of this 102.61. What we see over here is bond prices closer to present are much higher than that level, but the rates are not better. The rates are very close to where we were here in the beginning of March, but they're not quite as good. So what's happened over the last 2 business days? We're going to go back to the 2-day view here. This is the last trading day of the week last week on Thursday. And that is when I shot the video basically making a strong recommendation to lock in if you could. I was able to lock in a number of people on Friday. Even though the markets were closed, we were still able to register locks based on the pricing on Thursday. Today, after the long weekend, we saw mortgage bonds open at lower prices, and they just started going down and down from there. At this point, at about 11 a.m. Eastern time, we saw them dip big time, and there were, at that moment, price changes for the worse. Many lenders at that moment, they're very quick to make the rates worse. They're not so quick to make them better. So when the bond prices are falling, we saw essentially that pattern repeat itself for negative price adjustments. Bond prices rallied for a little bit as the Fed was still actively purchasing mortgage bonds. And then this drop-off right here tells a very interesting picture. And it's what I've said over and over again. When that tap closes, the mortgage bond prices suffer for it. So we've seen those bond prices just essentially fall off of a cliff. Now, in real terms, they're still at that price level of 104, but they're not nearly as good as they were over here last week at 104.63. It looks like that was probably about the highest. Rates are worse today. How bad are they? They're still good, historically, of course. They're not as low as they were last week. We're probably off by about 1/8 of a percentage point, depending on your particular scenario. So again, pricing is worse right now. I'm sorry that I was right. I wish I wasn't right, because trust me, there are a lot of people that were, even just for logistics reasons, waiting to today to lock in. I talked to several people over the weekend that were ready to go, but unfortunately I had to hit them with some less than fortunate news this morning that pricing was off. Again, the question is always going to be, okay, so pricing has gotten worse. Does that mean that we should wait around? It's very difficult for me to answer that, because on one hand, we have seen a pattern of rates get to their best levels. They stick around there for a very brief period of time, maybe a day, maybe a few hours, maybe 2 days, and then the pricing gets worse. It gets worse for anywhere between, 3 and 7 days, and then it does have a tendency to get better. The question is that pattern always going to repeat itself? What I have seen is, and I'm going to go back to this 3-month view again, the one thing to keep in mind is that we, at no point during this cycle of the rates getting better and getting worse, at no point during this cycle recently have we seen the rates get back to the ultra low levels that we saw in early March. So what I think may be happening, and again, I could absolutely be wrong. There are a million reasons that I could be wrong. There are so many things going on right now that it just limits the ability of anybody to accurately predict what in the world is going to happen next. But what I see in general is we have not hit the levels that we were at here in March, and I think that we're very unlikely to see those levels again. The big difference between the bond price here at 102.61 when the rates first dropped down to their lowest levels, the difference between that bond price level and now is that these higher bond prices, everybody knows that they are essentially artificially influenced. The Fed is buying mortgage bonds. It's giving an artificial kind of like a shot in the arm to keep those bond prices up. But the end investors, they're motivated by a couple things. Number one, they don't know if these bond prices are sustainable. They seem to be very, very susceptible to change when the Fed turns off the tap. And then two, as I've mentioned in previous videos, the big institutional lenders also have capacity concerns. They've got a lot of loans coming into the system. They may be less interested in buying the market in terms of getting more volume in. And then the third thing is the lenders are also subject to risk associated with people that are not going to be making their mortgage payments. So what is my advice? What are you to do? I'm going to sound like a broken record here. But if you like it, I would lock it still. The pricing today is not that much worse than where it was last week. We can wait around. Certainly if you're in a position where you don't really need to refi, if you've got a 3.625, 3.75, 3.5%, I can certainly see the case to be made to wait around until maybe we get to a more favorable level. But you have to know in that case, we may not see those levels again. We may not see a sub 3% 30-year fixed rate with no points. It just might not happen. Now, if you are one of those folks that has a 4 in front of your rate, I really think that you can get sad about the fact that the rates are not where they were on Friday. They're not where they were at on Thursday. But I would not let that change the way that you view the fundamentals of your refinance. A refinance is cost versus benefit. If there is a way to achieve a cost and a benefit that puts you in a better position tomorrow than you're in today, I think you should strongly consider doing that. I would be happy to take a look at your scenario. Please feel free to give me a call, shoot me a text at the number below. Again, I wanted to thank everyone who has reached out to me. I have been absolutely blown away at the reaction that I've got from doing these videos. You know, my view counts are only in the hundreds, and I'm getting a lot of inquiries. So I just really want to thank everybody that's reached out. It means a lot to me. So thank you very much. We'll talk again soon. By the way, please like the video and also subscribe to the channel. If you know anybody else that may benefit from this information, please feel free to send them a link to the video. I would love to talk to them as well.